Hey, what's going on, everyone? What's going on, Brickster and Discord, NG, Forsaken, Black Shirt? That's the Swinging Bull with PB Alerts. I'm also live on YouTube, Twitch, Twitter, Kick, all those fun places. Let me just share my screen in the Discord. I'm gonna share my screen, and today I just wanted to go over some of the different trades that I use to target weekly and monthly income, that kind of thing. Wasn't sure what the turnout was going to be today. Of course, the market closed at 1 p.m. Eastern today. There's still after hours session going on right now. It ends at 5 p.m. Eastern. But of course, tomorrow's July 4th, so the will be closed tomorrow. But yeah, let me just jump right into it. So I kind of wanted to go over cash secured puts, and then I also wanted to go over covered calls, and then we may touch on spreads a little bit, but not going to get in too much detail. But definitely wanted to go over the basics and just let everyone know the types of trades that I do. So we'll jump right in. I got a couple slides I'm going to go over, and then we'll go over some examples. So first, what's a cash secured put, right? We hear people have heard that, and if you don't know what it is, they kind of wonder what it is. It's basically having enough money in your account to cover the cost of potentially buying an underlying stock that you sell a put on. So we can kind of break down the strategy. I've got some people in Discord. Can just a quick show of hands. Can y'all hear me okay? I can try and disconnect again and reconnect just real quickly. Okay. Okay, everyone should be able to hear me now. And we'll get right back to it. So cash secured put, I know a lot of you in the Discord probably already know what this is, but I am streaming live on YouTube and everything else right now. So maybe there's some people out there that don't know what it is. So we're going to break it down. So basically, what's going on here is we need to obviously know what a put option is. It's a buyer of a put has the right to sell a stock at a set price until the contract expires. And the seller of the put, which is what we are, we have the obligation to potentially buy the stock at a set price. That would be the strike price. And we, as the option seller, we receive a credit on the onset of the trade. Let me check a few other things here. Give me 1 second. Okay, yeah, everything should be streaming fine. So I'm not sure why people aren't able to hear me on the Discord, but I'll keep going here because I'm live on YouTube. So anyways, we're the seller, so we receive a credit on the onset of the trade. Okay, so most of my trades are sell to open. Okay, and let me do this one more time. We're having technical issues in the Discord right now, which is not surprising. This is the last time I'm going to go and come back. All right, because I got to get on with this. We got a bunch of people on YouTube waiting. So, okay, so how does the cash secured put work? So how it works is basically if the current stock price stays above our strike price until the expiration date, then that's how we make money. All right. If the underlying stock price falls below our strike price, that's when we're in a situation where we can get assigned the stock. Okay. So with that in mind, whether the market price is just below the strike or significantly below the strike, if your strike price gets breached to the downside, you will get assigned shares. And if that's the case, we kind of just what we call the wheel strategy. So once you're assigned shares, then we rotate the wheel and start selling covered calls to collect even more income. So let's just go over a quick example. I'll just say XYZ company, right? Just as an example. Let's say it's trading for $55 a share, and we're neutral to bullish on the stock. So what we could do is sell a $50 strike cash secured put, and we would receive credit for that. So what will happen is once we sell the cash secured put, if XYZ stock stays above $50, then that's would be considered a winning trade, and we get to capture all the credit we received when we opened up the trade. So let me just go to Webull real quick, and we'll kind of just go over a live example here instead of me reading off the slides. So I'm going to go with let's see what Apple looks like. I usually, before I sell cash secured puts, I usually look at the bigger time frames. I try not to sell them after a stock's kind of just rallied. Like you can see Apple here, it's been rallying for the last 4 days, and kind of looks like it might be kind of around resistance level. So this kind of wouldn't be ideal for me. What I'm trying to find are stocks that are around support, right? Or coming off of a pullback, something like that. We can look at, I mean, I guess we could look at AMD. It's kind of coming off of a little bit of a pullback here. But let's say I think the price of AMD is going to stay above 135 bucks. We can just use yesterday's daily, the bottom of yesterday's daily candle, and maybe the day before. And this is just, you know, as an example. I'm not saying go long on AMD right now, but I'm just trying to kind of teach the strategy a little bit. So you find a stock, there's a little technical analysis involved. So you kind of look at the bigger time frames and try and find a support level where I think the stock will stay above, the underlying stock price will stay above. Let's just say we think AMD is going to stay above 135. All right. So then we go to the option chain, and my trades are usually 2 to 4 weeks out. We can look at this one 30 days out here. And if I was to sell this $135 strike on AMD, then you can see here that these are going for, we can maybe just take the last sale here, just 4.97. So that's $497. And that's the amount of credit you would collect when you sell the cash secured put. All right. So how to determine what your break even is you take the strike that you sold, the 135, and then you just subtract the credit that you received. So in this case would be 4.97. So technically you would just, since you received a $4.97 credit, which is $497, technically you would just need AMD to stay above the break even, which is $130.03. Anything above that, and it'll be a profitable trade. To get 100% capture of the credit that you received when you sold to open the 135 strike put, you would need the price of AMD to be above 135. But there still is a little bit of a profit zone between your break even and, of course, the 135. So as long as it's above your break even, it will still be a profitable trade. And as you approach expiration, I would suggest, you know, because let's say it's trading around 132 or something like that. It's $2 above your break even, but it's $3 below your strike price. Then I would probably close that out like a day or two before expiration. If you're not looking to get assigned on it, right? Maybe you're just doing a cash grab, technical analysis cash grab. But so just keep that in mind. If the underlying stock price is below your strike price, but it's above your break even, there is still profit to be had there. And if you're not looking to get assigned the shares, then you probably want to close that out before you get to the expiration for whatever profit that's going to be there. Of course, you can be assigned shares if it's below your strike. You know, that's probably where the assignment's going to happen. Without a doubt, if it's below your break even, you're going to get assigned for sure. So that's kind of how you figure out the break even. You just take the strike price that you sold to open, and then you subtract the credit that you received. All right, so that's an example of selling a cash secured put on AMD. Now, One thing I want to mention is how much capital would you need to sell that cash secured put? Well, anytime you're selling cash secured puts, it's the strike price times 100. And then, of course, if you're doing multiple contracts, it's times the number of contracts you have. But we'll just stick with one contract for now. So the 135 strike times 100. So you would need 13,500 to sell the cash secured put on AMD at the 135 strike. That's how much your broker would put on hold. And I'll talk about how to still kind of participate in a similar trade without needing all that buying power, which would be a put credit spread. So I'll talk about that right after we go over this. But let's talk about what kind of return on your capital you'd be looking at with this trade. So your broker's tying up 13,500 to sell the 135 strike on AMD. And if you're receiving a $497 credit, then and the trade works out and AMD stays above 135 and you pocket that 497, then 497 divided by the 13,500. So that means this would be a 3.6% return on your capital. All right. And that's only a 29-day expiration. So, I played the long game. I'm more of a conservative trader. I know a lot of people go for home runs a lot. And some people will say, 3.6% return in 29 days, and they think it's not a good trade. But they're being a little closed-minded. You got to kind of open up your mind a little bit on this. I do my math based on return on capital. And look at, if I can get 3.6% return on my money every month, I mean, do the math. You can do that consistently for 12 months. I mean, that's going to be a 43% return on your money at the end of the year if you know what you're doing and you're consistent with it. That's a solid return. You're beating the S&P annual average by like 4x. So you got to kind of look at things in a bigger picture when you become an option seller, right? If you're interested in writing contracts and you've never done it before and you're just used to the rat race with trying to day trade SPY every day and, make as much money as you can, this and that, you got to kind of change your mindset when you become a contract writer. It's not so much for me, it's not so much getting rich quick anymore. It's I want consistent gains every month while remaining relatively safe, right? Because I know if the trade goes against me, what's compare it to day trading, trying to day trade options, and if you're wrong, that thing can go to zero and you got nothing. You lost and that's it. And the thing with writing contracts, is specifically cash secured puts, is I know I'm not gonna. If I'm wrong, I know I'm not gonna walk away with nothing. I'll at least get the shares, right? And so I know that, hey, all right, I was wrong about AMD's direction this time, but hey, at least I got possession of the shares now, and then I can go ahead and go to the next step of the wheel strategy, which would be selling the covered calls, and then I just would target income on that side, on the call side, and then I just rinse and repeat as many covered call cycles as I can until my shares get called away, and for overall net profit. And that's kind of how I trade. So that's kind of how I think about things when I'm writing contracts. Is I'm looking to make maybe 3 to 5% or more every month on my capital, and at the end of the year, you got a real nice return on your capital on an annualized basis if you stay consistent. So that's kind of the trade, the example I have on AMD. If you were to sell the 135 put, now we were talking about the buying power needed, and which was quite a bit for a lot of people, $13,500 to sell that 135 cash secured put. The way to reduce the buying power needed, if you still wanted to do a trade like that, and you didn't want to put $13,500 of capital being tied up, what you could do is just convert the cash secured put to a put credit spread, right? And I do a lot of that, especially when I don't want to tie up a lot of capital. And the way you could do that is let's say we have the same thesis. We think AMD is going to stay above 135 by expiration. Well, what you would do is on one trade ticket, you're going to add a second leg to your trade ticket. So it's actually going to be two trades on one ticket, okay, with your broker. So the first leg of the trade is, of course, selling to open the 135 put. All right, and I'll just go on the prices on the ask here. So the 135 put's going for $495. So you would get a credit for that. All right. And then on the very same trade ticket, you can buy to open your second leg. Let's say it's the 130 strike. That would actually be a debit. All right. So if you sold to open the 135 and you bought to open the 130, both on the put side, both same expiration date, the 130 debit that you would pay for that second leg, that's 3.05. So that's $305. So you take the 495 credit minus the 305, and that gives you $190 overall credit on that spread trade. And if the strikes on your spread is the 135 and the 130, what you've done there is just formed a 5-wide spread. And in the option world, it's always times 100. So for every $1 wide, it's $100 in capital you'd need to do the trade. So on a 5-wide spread, how much money would you need to trade that? Well, we just talked about that. So you're going to need $500, right? Because it's 5 wide. So yes, I'm collecting less credit than selling the 135 cash secured put by itself. Because if I did it by itself, I would collect almost $500, but I would need $13,500. The way around that is go ahead and form a 5-wide spread. Now all you need is $500. Okay. And then you would get a 190 credit. So 190 divided by 500, that's a 38% return. So with the spread, you're getting a way bigger return on capital. However, if if the spread goes against you, then you would be taking a loss, which would be if it's 5 wide, it's the value of that 5-wide spread's worth of 500 minus the 190 credit you received. So yes, if the trade goes against you, you are at risk of losing $310 if you don't manage the trade. Of course, when I do spreads and they go against me, I manage those trades. That's what I do over here in the Discord, is kind of help the members manage the trades. Because if it goes against me, I don't want to take a $310 loss, right? And that will happen if you open the spread and it goes against you and you don't do anything about it. And expiration comes around the corner, and here we are. You'd be looking at a $310 loss. The way to kind of mitigate that a little bit is if I received $190 credit on a 5-wide spread, what I like to do sometimes is implement what I call a 2x credit received stop loss. All right. And that's how you're going to keep your risk reward to 1-to-1. All right. So how you do that is you just take, okay, if I received $190 in credit, and you just times that by 2. So that's $380. All right. So what you could do is, as soon as the value of that spread, because the entire spread at the end of the day is worth $500. But once the value of that spread hits 380, then we know it's gone against us a little bit, right? But what you could do is consider closing out the spread. You would pay a 380 debit, but don't forget you collected 190 on the onset of the trade. So your net loss is only going to be 190. That's how you keep your risk reward 1-to-1. You're risking 190 to make 190. That's 1-to-1 risk reward. And that allows you, where if you do take a loss on a spread, as long as you keep risk reward 1-to-1, you can make that back on the very next trade. All right. So that's kind of just one of the risk management techniques that I've used when trading spreads. Another management technique because that's what people want to know. They're like, all right, this is all great, but what do you do when it goes against you? That's really what most people want to know. And Kwani Sosa on YouTube asks, great question. How far out would you recommend on average a spread to be? I like mine, 30 to 45 days out is kind of the sweet spot for me, because especially with out of the money credit spreads, the profit that we're potentially can get is all theta decay. It's all time value, right? Because if the spread's out of the money, the potential profit is all extrinsic value, is what we would call it. 30 to 45 days out, that's probably the sweet spot for time frame as far as what your expiration date would be. So Kwani Sosa, I hope that helps. If volatility is super high and there's been some really dramatic moves in the markets, like intraday, because VIX is over 20, 25, 30 or something like that, I will shorten the time on my expiration dates, because I don't want to be married to a spread trade for 30 to 45 days if we're seeing crazy moves, intraday and on a week-to-week basis. I'd rather have shorter expiration times when volatility is high. When volatility is low, I like 30 to 45 days. That's kind of my sweet spot. So I hope that clarifies their Sosa on YouTube who asked that question. And also, the question I get is, how wide should we have our spread? Should I do the dollar wide? Like on SPY, you can do $1 wide spreads. Even on AMD right here, you can see $1 wide strikes. So I get that question too. Like, how do I know when to do $1 wide or $5 wide? And it all goes back to volatility for me. When volatility is high, you want your spreads to be tighter. That way, your protective leg on the spread holds its value a little bit more. So when volatility is high, I like my spreads to be tighter. When volatility is low, I'll go ahead and widen out the spread a little bit, and that's just what's worked for me over the years. So I hope that kind of helps clarify those kinds of things there. So we talked about cash secured puts. We talked about put credit spread, and we talked about the difference in the buying power needed when we're looking at a cash secured put compared to a credit spread. And you can obviously tell from everything I just went over that credit spreads do have a better return on capital than cash secured puts. However, I think cash secured puts, there's kind of a second layer, which means if the trade does go against you, at least you have shares to show for it at the end of the day, and then you can proceed to start selling covered calls and just wheel your way out of it. With spreads, yes, you could take assignment on your short leg if you wanted to, but the bulk of the traders that I see, because they're only getting a portion of the credit on a credit spread that you would get on a cash secured put, they tend to increase their lot sizes quite a bit to try and equal what they would get on the credit for a cash secured put. So doing that alone might put you out of the ball game of even being able to exercise on that. Your short leg. Most people that trade spreads, it's usually they open the spread, the two legs on the same trade ticket together, and then they close them together. I would suggest, not financial advice, but you need to have a lot of options, advanced options experience to be able to manage these spreads, to manage the legs individually. You can find yourself in trouble if you start messing with the individual legs. So if you're newer to trading spreads, just open them at both legs at the same time and close both legs at the same time until you can get the hang of, how to manage these things as a whole and stuff like that. And then once you've built up quite a bit of an experience, then maybe you can consider managing the individual legs on a spread separately. I've done that before. I've got tons of experience trading spreads. So for example, one time I had a put credit spread on a stock, this, which means we're neutral to bullish, right? Because we're technically short the puts if you're receiving credit on the put side. So I was neutral to bullish, but it just didn't go my way. I was wrong about the direction. I accepted the fact that I was wrong about the direction. And usually when we're wrong about the direction, it usually keeps going against us, right? So that's where the 2x credit receipt stop loss kind of comes in. But I have managed the legs individually before, where I would go ahead and close out my short leg, and then I'll let my long leg ride if I do think it's starting to trend down, it's starting to go against me, and if I think it may continue trending down, then I will close out my short leg. And then a lot of times I'll make the loss that I take on the short leg, I can usually make back on the longer leg that I kept open. So like I say, there's a way to manage them individually, but if you don't have a lot of experience doing it, the max loss that we predetermined before we open the spread could actually end up being a lot more than if you were just to treat it as a spread as a whole. So I don't want to find anyone getting themselves into trouble trying to manage the legs independently until you've had like a lot of experience under your belt and you feel comfortable doing that. But again, I don't want to sound like a broken record. If you're new to spreads, you probably want to manage the spreads as a whole and not the individual legs. Okay, so just, I just think it's good advice from what I've learned over the years. Definitely get some experience under you before you start doing that individually. But you can make a lot of money on spreads just managing the spread as a whole. That's probably the best way to go about it. So we can go over a few more examples just so everyone's really clear. Again, we'll pull up an example of a cash secured put. We'll go over the math behind it as far as return on capital and what the max risk is and what your break even would be. And then we'll compare those mathematical numbers to what it would be to a similar trade, but using a credit spread instead of a cash secured put. So basically let me just kind of pick a random stock here that I think maybe a good candidate for a cash secured put. You can see Target here. Kind of looks interesting. Been trending down for a while now. Kind of trading sideways for a few months, and it got down here for earnings. Tried to recover, and so we'll just go off of the when it was trending down from here. So yeah, kind of trending down for most of 2025, right? I mean, this is from January. Price action below both of my EMAs. I use the 9 EMA and the 21 EMA when I'm looking at price action. So usually when the underlying stock price is on one side of the other, it usually turns into a pretty good trend. You can just go back in the history and look at that. But so you can see the price was below the EMAs, trending down since January. It's finally starting to look like it's recovering a little bit. And sure enough, now the price has finally popped back above the 9 and 21. So that could be just an easy signal right there that, hey, maybe this downtrend looks like it's probably over with. It's actually making higher lows now and higher highs. We've got an ascending channel, if you will. And you could just use the tool on Webull here and just, kind of draw it out like that. So it's obviously in an ascending channel. So maybe this would be a candidate for the wheel strategy, and maybe we've caught it at the beginning of its reversal here, and we got some time to sell some options on it, right? So Target's trading around 104. I mean, even just the mental level of $100, that's always a good level, I think. Any stocks that are trading around 100. Just a real easy level, $100, just a good solid mental level. So let's just say that we think Target is going to stay above $100. Again, I'm just figuratively speaking here, just so I can explain the example. So we think Target, we're neutral to bullish on Target. We think it's going to stay above $100, and I want to sell some options on it. I want to bring in some income on it because of that thesis, if you will, right? So already looked at the chart. We know Target's a strong company. I mean, obviously a profitable company, positive. I do look at the fundamentals a little bit before I start writing contracts on stocks, because I don't want to do this on shitty companies, right? Let's at least make sure it's a solid company, and we don't got to worry about no 50% downturn on the stock overnight. That's the crap you get with the biotech and the pharmaceutical companies and the therapeutic companies. I don't even touch those things. All right. I may day trade those stocks for fun every now and then when there's some morning momentum or something. But when I'm running the wheel strategy or using options to target weekly and monthly income, I'm typically doing it on good companies. Right? Either they got a big name, a big household name, or their financials and fundamentals are positive. So I just look for, make sure they got a positive PE ratio. This target, of course, does. EPS is important. I like to see that positive. And Target actually pays a dividend, 4.3%. So that's actually a little cherry on top. That's always a bonus there. Because if we're selling cash secured puts and we get assigned stock, well, hey, not only do we have stock now that we can run covered calls, but now we can start collecting the dividend, right? So that's another form of income. We kind of put in another form of income there if it pays a dividend. So that's great. And then, I do look at the income statement. I would prefer the stocks I write contracts on to have positive net income. So that's just a simple stat you can look up on most brokers. It's going to be on the income statement, and you just want to make sure they have positive net income. I don't like writing contracts on companies that aren't profitable. That's as easy as that. Okay. So of course Target's profitable. And then I do like to look at the balance sheet and just get a gauge of what their debt to asset ratio is. Debt to asset on Target 73%, so that's fine. So that would clear my checklist there. You just don't want the debt to asset to be over 100%, because that would mean the company's over leveraged, and it's not a good thing. They have more debt than assets, basically, so that's not a good thing. So Target, meets all my fundamental criteria that I would want to see before I start writing options contracts on it. So anyways, let's go back to let's go to the option chain now. So this would kind of be the next step, right? And I'll just go 30 days out, just an easy number to work with there. And again, our thesis, and again, this is figuratively speaking. This is not a trade alert, all right? I'm just trying to explain it so everyone can understand this. So our thesis on Target is we think it's going to stay above $100, all right? So let's go over the math behind the cash secured put. We'll go over what the return on capital is, what our break even is going to be, how much capital we would need to trade it. And then we'll compare that to a similar trade, which would be a put credit spread, and we'll go over the math on that and just do a little comparison to figure out kind of what kind of trade you want to do. It's obviously going to depend on how much capital you got with your broker. But the $100 put on Target, if we were to do a cash secured put on that, which basically means we're writing the contract, we're creating the contract to sell to somebody. We're kind of like little mini market makers, right? If you're a contract writer, you're basically a little micro mini market maker, all right? It's kind of a cool title to have, So this $100 cash secured put, first things first, how much capital would we need to sell that $100 cash secured put? Well, we went over this at the beginning of the stream. It's always going to be the strike price times 100. So if the strike price is $100, well, times that by 100, you will need $10,000. Your broker would put that on hold while the trade is open. And that's how much capital you would need to sell a cash secured put by itself. Now, on that $10,000 in capital, I'll go with the prices on the ask right here. It's selling for $195. All right. So if you collect $195 on that, and you have to tie up $10,000 for the cash secured put, should be pretty easy math, right? So that's almost a 2% return on your capital in 29 days, or 1.9% to be exact. Not a bad return. Like I say, if you're not used to writing contracts, this might not seem fair. Like you're like, wait a minute, I got to put up 10,000 to only make 195, and you're like, yeah, that doesn't make sense. I'm not doing that. Well, that's because you don't really know how writing contracts work. It's a lot different than buying options. Okay. And what we look for is consistent income every week or month while remaining relatively safe. And as long as you've done your fundamental and financial, little bit of DD before you entered the trade, you should be okay owning Target. All right. If you get assigned shares at $100 on Target, you should be okay with that. You kind of have to be okay with that before you open the trade. So as long as you're doing it on a good company, you're going to be fine. You're going to be okay. All right. And for me personally, if I can get 1.9% on my capital every month and do it consistently for 12 months, that's a 22%, a little over 22% return on your money in a year. That's good. That's pretty good. You just beat the S&P annual average return by 2x. So in my world, that's it. That's good. This is good. All right. Now the $100 cash secured put, again, you need 10,000 for that. What if you're like, no, I don't want to put 10,000 up for that to get $200. I don't want to do that. And maybe some people don't want to do that, and that's fine. The way around it, we spoke about this earlier in the stream, form a put credit spread, and then you'll only need a fraction of the capital, and you can still get a really good return on capital, actually a lot better return on capital than you would do a regular cash secured put. But again, if you're trading the spreads as a whole, opening and closing them, the difference between the two is, yes, I'm tying up more capital with the $100 cash secured put, but if I'm wrong about the direction, I'm going to be awarded shares. Okay, I'm going to at least have shares to show for it. And then I can rotate the wheel, go immediately to the covered call side, and start rinsing, repeating those covered calls. All right, and that's the trade-off. All right, with spreads, and again, if you're opening the spread both legs at once and closing both legs at once, you're not interested in being assigned, because maybe you don't have 10,000 in your account. Maybe you only got a few thousand in your account, but you're like, how do I trade similar to a cash secured put, but not need all the capital? That's where the put credit spread comes in. It reduces the capital needed. However, if you are wrong about it and the underlying stock goes against you and you lose that spread, you're not going to have any shares to show for it. That's the trade-off. All right. So with the spreads, you kind of need to be right, or you're going to take max loss. But the max loss is going to be tremendously lower than what you have at risk for a cash secured put. So for instance, let's say, okay, we figured out what the math is behind the $100 cash secured put strike on Target. All right. And we know what's going on there. Now let's say, all right, well, that's all fine and dandy, but I don't want to put 10K up. That's just too much. I only got like 3K in my account. So I'm not even interested in being assigned on this, right? Then that's when you can do the 5 wide spread, or you can do a $1 wide spread. I like to target a minimum of 20% on my credit spreads or more. All right, that's just what's worked for me over the years. So to do the math on it, we'll do 5 wide first. So if I sell to open the $100 strike, then that's going to be $195 credit, right? I want to sell to open that one. And then I buy to open the $95 strike to form the spread. That's actually going to, actually, I'll just take the last price here. So the $100 strike, the last sale was $193. And then the 95 strike last sale was $80. So we get a 193 credit for the 100 strike. Then we got to minus out the debit for the 95 strike, which was $80. So on this 5 wide spread, I can collect $113 credit for each spread. All right. So yes, that is less than the $200 roughly that we would receive if we sold the $100 strike cash secured put by itself. So yes, we're getting like half as much. But instead of needing $10,000 to sell that cash secured put, you could just form the put credit spread. And if it's 5 wide, take a wild guess how much capital you're going to need. You're only going to need $500 because you formed a 5-wide spread. So yes, I'm only collecting $113, which is less than the $200 credit I would collect by selling the $100 cash secured put by itself. But on the same token, I've received a drastically reduced buying power needed, right? So instead of needing 10,000, now I only need $500. And if I can bring $113 in on a $500 in capital, now that's a 22% return on my capital in 29 days, compared to only a 2% return if you did the cash secured put by itself. But again, don't just start piling into credit spreads, because if these spreads go against you, you're at the end of the day, you're not left with anything. That's the trade-off. With the cash secured put, at least I know that if I'm wrong, if I'm wrong about it, I'm at least gonna have 100 shares of target that I can go ahead and move and start selling covered calls on. So that's the switch off. Yeah, spreads pay more than cash secured puts, but if you're wrong about the spread, you don't really have anything to show for it. So that's the trade-off. I do a mixture of both trading strategies. I run a ton of the wheel strategy. It's mainly on stocks that I don't mind owning. And if they pay a dividend, even better. So we're selling cash secured puts to get into stock, see how many cycles of cash secured puts we can do. I mean, I've done like 5 cycles of cash secured puts and brought in $1,000 in credit before I even own one single share. So I'm basically just writing contracts and I'm collecting credit, and all these contracts are expiring worthless, and I'm pocketing all that credit I collected on the onset of the trade. I've been on the cash secured put side of a wheel like 4 or 5 times. It happens a lot, actually. Between 3 to 5 times, I'll be able to get 3 to 5 cycles of cash secured puts in before I'm even assigned one share. And so I'm generating income without even owning any shares of the company. So I've done that a lot. And I usually will run the wheel on good companies that I don't mind owning. That's the catch. You have to be okay owning the stock and then rotating the wheel to the covered call side. You have to be okay with that before you do these cash secured puts. If the trade that I'm targeting is more of a technical analysis cash grab, and I don't want to be assigned shares, I'm just trying to get in and get out for some quick credit, that's when I'll probably do the spreads, because then I can increase my lot size a little bit. And obviously the return on the credit spreads is a lot better than the return on the cash secured put. So just to give you an idea, I got that asked the other day, like what's going through my mind? What's going through my mind when I decide if I'm going to do a cash secured put or am I going to go the credit spread route? Well, I just gave you the reasons. If it's a stock I don't mind owning, and if they pay a dividend, then hell yeah, I'll just do cash secured puts on that, because I don't mind owning it. And if I get assigned shares, I'll sell covered calls and get income there. So you got income on the cash secured put side. And then if I get assigned, now I can get income on the covered call side. And if they pay a dividend and we catch it in the dividend cycle, now you have a third stream of income. So now you've just turned that trade into like a triple income trade. So these things can really morph into making you more money than you originally thought at the beginning of the trade. And that's why I love the strategy so much, because these things can really mutate into multiple income streams. But that's what would be going through my mind when I'm trying to decide, am I just going to do a wheel on this where I'm selling cash secured puts, or am I just going to do some technical analysis cash grabs with some spreads? And that's how I make my decision. So I've done spreads on companies that don't really have too good fundamentals and stuff like that. And that's because I'm just trying to do a quick cash grab. I'm not looking to be assigned. I'm just trying to get in and get out for some quick credit. But again, if it's a really good stock with good fundamentals, good financials, and better yet pays a dividend, I'll probably just do the wheel strategy on that one, because I don't mind getting shares on it, right? But yeah, so that's basically the 2 examples on target. So we went over some examples on, what was it, Apple? or no, AMD. We went over cash secured put example on AMD and a put credit spread example on AMD. And then we just did a target example, cash secured put, and then a put credit spread example on target as well. So that was some pretty good examples there. Let me make sure I didn't miss any questions in the Discord. Weston on Discord. In your coaching course, do you start with the basics of options, or is it only advanced options such as spreads? Yeah, I mean, I can definitely break down the basics for you, like what a call option means and what a put option means. I can usually explain those pretty easily and give some examples on that. So yeah, if you do join my coaching group in the Discord and you need a little bit of extra help on the side, just kind of getting the foundation down of options, I don't mind carving out a little bit of time for you to explain it. So Weston over here in Discord, I hope that helps maybe answer that. So absolutely, you're more than welcome. You don't need to be like a seasoned vet to be in my coaching group. I got a lot of people in my coaching group that just kind of trying out options for the first time. I do recommend having a solid understanding of basic options before you try and tackle the spread part. But I can easily help you get a basic understanding of the options. As far as the Greeks, you hear about the Greeks a lot on the options chain. Like, what's the delta? What's the gamma? What's the theta? What's the implied vol mean? I can definitely help explain all that stuff to you, and then we can move on to spreads after that. So no worries at all. Yeah, so my wheel strategy trades, and anyone who's already in my coaching group can attest to this. I always have usually between 4 to 6 wheel trades, 4 to 6 separate trades going at one time, at all times. All right, so 4 to 6 trades going at all time that are always open. And I'm closing for profit and opening up new trades, but I call it like a pipeline. So I usually have a pipeline of 4 to 6 trades. That's just for the wheel side. And then every week I do alert a new spread trade. So there's 4 of those a month. So there's 4 spread trades a month, basically. And sometimes I'll do 2 spread trades a week. So it's between 1 to 2 spread trades every single week. And then of course I always have my 4 to 6 wheel trades going at all times. I always have 4 to 6 of those going at all times. So those are constantly open, getting closed and opened. And I keep a good solid pipeline. Trust me, I'm never lacking content to go over in my streams. And every Monday in my coaching group, every Monday at 2 p.m. Eastern, I show my Fidelity account. I'm an open book. I share my screen. We go over every single open trade that I have, and we go over any management that needs to be done, whether I'm closing it for profit or I'm opening a new one. Every Monday at 2 p.m. Eastern, I go through every single one of my open trades in detail with my team, so everyone understands exactly what's going on. So I got skin in the game. I know people that are part of some of these Discords, and they're throwing alerts out left and right. And what's funny is I've heard from feedback that they're not even trading. They're not even personally in the trades. They're just shooting out alerts. And I don't roll that way. Okay, but when I alert something, I am actually in the trade right with you. All right, I have skin in the game with my trades, so that kind of sets me apart, I think, than just some random Discord where someone's spitting out all these alerts, and half the time they're not even in the trades themselves. That's that. I don't like that. So me personally, I'm the trades that I put out there on the wire, I am personally in those trades with the team. And every Monday we go live and we go into detail and go over the status of all the open trades together. Okay, yeah, Weston. Yeah, Weston said, thank you for the answer. Absolutely, no problem. And Rudel Trade on Discord, I hope that answered your question about how many like alerts in my coaching strategy group. Again, I try to do 1 to 2 spreads every week, And then there's always 4 to 6 open wheels going at one time at all times usually. So, but yeah, look at that. It's been about an hour. That's really all the time I had carved out for today. Of course, this is typically when I do my earnings streams every Tuesday, Wednesday, and Thursday. But of course, there was no earnings going on today. So I figured I'd just come on here and talk about the different ways I trade. I thought that would be pretty interesting. And yeah, so if you're interested in any of that, again, my name's the Swinging Bull with PB Alerts. If you're looking for a new trading community, especially everyone tuning in here on YouTube and Twitter and Twitch, definitely check us out. There's a link in the description. You can just join the free section. Don't even cost money, and see how you like the free section, and kind of go from there. And if you do join, tag me in the chat. I'll come by and say hello. Maybe we can chat for a little bit and see if I can help you with the situation. Whatever situation you're in, maybe there's some tips or tricks or something I can clarify for you. Got one final question here from NG on Discord. Do you write weekly or monthly options? Do you need a special account to be able to write options? Okay, so cash secured puts and covered calls, you can absolutely do that on a cash account. You do not need a margin account to write contracts that way. But you do need the cash to be able to cover the assignment if it goes against you. So again, it's always the strike price times 100. So let's say its stock is trading at $5.50, and you think it's going to stay above $5. You could sell to open the $5 put. So now you're writing that contract, not buying it. You would collect a credit. Technically, you're short the put, so you're either neutral to bullish on that. You want the underlying stock to stay above 5. If you're selling the $5 strike on a cash account, it's $5 times 100, so you'll need $500. Your broker's going to put that on hold while that trade is open, and if the trade goes against you, your broker's going to use that $500 to buy shares at the $5 strike on your behalf. But if the trade goes in your way and it stays neutral to bullish, then that contract just expires worthless, and you pocket all the premium you collected on the onset of the trade. So cash secured puts, you can do it on a cash account. The same thing with covered calls, because covered calls, that's backed by actually the shares, right? As far as the spreads go, okay, yes, you would need a margin account for the spreads. All right, so NG on Discord, hope that answers that. And I do both weekly and monthly options. Okay, I do both. Just really depends on the underlying. Some underlyings only have monthly cycles, and then other underlyings have weekly cycles, and it just depends how I feel about the underlying, and the recent price action will determine what's the volatility at in the market right now, and that'll determine whether I go weekly or monthly, and it will also determine how wide or narrow the width of my spreads are. But yeah, that's all I got for today. Just wanted to answer a couple last minute questions there for the Discord members. But yeah, if you're looking for a new home, come join us. My name's the Swinging Bull. My real name is Benjamin. My friends and family call me Ben. But my Discord name is the Swinging Bull. It's with PB Alerts. Come check us out. If you do end up joining, I definitely look forward to meeting you. But I hope everyone enjoyed the stream. Hope everyone has a great night and a great 4th of July. And I'll see everyone very, very soon. Cheers.